Now let's bring in our next guest, Greg McBride. He's the Senior Vice President and Chief Financial Analyst for Bankrate.com. Greg, thanks for joining us today. You're such a special guest. We really appreciate you taking the time to answer some questions for our viewership.
Thanks for having me.
Absolutely. Greg, we're in a record position right now. We're doing a show on jobs today on President Trump. We're in 104 months of economic expansion. We have 7.6 million jobs outstanding. We have the lowest unemployment in over 50 years. The question is, can this continue?
It can. I think we do have to temper our expectations in the sense that we're not going to see the same pace of job growth that we had seen over the past couple of years, simply because the labor market's getting tighter and tighter. But as far as the economic expansion is concerned, yes, it can continue. And that's one of the reasons that we've heard talk about the Federal Reserve potentially cutting interest rates. It would be to sustain that economic expansion a little bit longer in the face of some other headwinds that may be buffeting the economy.
We've seen jobs pull back a little bit here recently. We had 75,000 created last month, and we had a really good month the month before that, around 268,000. But the average this year seems to be in the 160s. Where do you see the average going for the rest of the year? Are we going to keep seeing the lower number come in that will maybe get us into a range of 130,000 jobs a month to 150,000? What is your feeling there?
I lean more toward the 130 to 160,000 range as kind of being the norm through the balance of this year. Everybody freaked out whenever the jobs report came out for last month, and it showed only 75,000 jobs. And they said, this is like, the sky was falling. But look, we went through this same song and dance back in February. That we had a weak number that month. Everybody got all freaked out. And then what happened? March and April came back really, really strong. So one in a row is not a streak. Just that one number doesn't really mean a whole lot. I think the trend is what we have to look at, but I would just temper the expectations and realize that trend, it's going to be a slower pace of job growth than what we've seen in the past, simply because the labor market's getting tighter and tighter. There's more than 1.3 million open jobs that are unfilled. We have more open jobs than we have unemployed people, which again, testament to just how tight this labor market is.
Yeah, that's a pretty crazy number. I really consider that the greatest economic miracle and story that's not been told. Just imagine, Greg, what the jobs numbers would be like if we didn't have an aging population. Let's go back into the 90s. If we were in the 90s, the jobs numbers would even be significantly better because we have so many people leaving the workforce due to the long-term secular demographic change that we have in our aging population. But, with jobs starting to slow down, what do you think it will take for the Fed to act and lower rates? What's going to really motivate the Fed from here, besides just, giving us little feel-goods about the potential for lowering rates in their Fed meetings? What is it going to take on the macro data front and in the employment front for them to really act and lower rates, in your opinion?
Well, I think that we're coming into this year. We expected economic growth to downshift from that 3% pace last year to 2 to 2.2% this year. And so I think the risk here that the Fed is trying to get out in front of is if we undershoot that by any measure. If all of a sudden we're looking at economic growth coming in at 1.5%, I think that's the trigger for the Fed to act and do a preemptive interest rate cut just to give the economy a little bit of boost and help this expansion sustain itself a bit longer. Look, the Fed's looking at the data just like the rest of us. We have not seen material deterioration in the economic fundamentals. So a rate cut by the Fed at this point is not reacting to an economy that's rolling over by any means. What it would just be taking out an insurance policy to make sure that this expansion was able to continue.
Those are all good points, Greg. I think, though, the broader economists and many on the left have really underestimated the effects of what the policies Trump has done to enhance employment growth in our country via deregulation, the tax reform and the lowering of the corporate tax bracket, repatriation of dollars. Those things have all kind of boosted up the demand for jobs for corporations to kind of reinvest. And, what I didn't really understand before President Trump was elected was there's a psychology to business. And, people started spending money again when he became elected because he was pro-growth. But does President Trump, in your opinion, do you think he has the Midas touch and that jobs will continue throughout his administration?
Well, look, I'm a financial guy, not a political handicapper, but we have been for the majority of this expansion, really kind of handcuffed by that aging population. It's kind of kept a ceiling on the growth that we've been able to achieve. What we have seen over the past couple of years is some lifting of regulations and cutting of taxes that has given a boost to the economy. But I think long run, we are still going to be a slower growth economy just because of the fact that we have an aging population. And we also have a skills mismatch. I mean, we talked a moment ago about the fact that we've got more unemployed people than we have more open jobs than unemployed people, and the fact that that gap is the biggest it's ever been. I think a lot of that is just the fact that, we can't plug people that are unemployed just into those open jobs because of the skills gap.
Greg, you gave us the apolitical answer, the safe answer. That's okay. I'm making fun right now. I'm having a joke with you. You can laugh about that. It's all right. No worries there. So listen, we've got to go to a break, and we'll be right back with Greg to answer some more questions. We're here with Greg McBride. He's the Senior Vice President and Chief Financial Analyst for Bankrate.com. Greg, thanks for sticking around.
Thanks for having me, Jeff.
Absolutely. Greg, asset prices are very high. The stock market is actually at its peaks again in terms of valuations, and we're actually in a late cycle of the bull market run here, late stage here in the market. As far as asset prices go, for our viewership that is at retirement or entering retirement in the next several years, should investors be defensive today?
I think particularly for those that are at or near retirement, look at more conservative investments, income generating equities, for example. Don't be chasing the crazy IPOs that are out there that don't have profitability and really don't know when they will be profitable. Those to me are late cycle indicators. I think what is most helpful to your financial needs going forward and protects you on the downside are going to be the more defensive equities, income generating equities, but yet are still in a position to increase the dividends over time, because after all, inflation can still have that erosive effect. Even at these low rates, inflation can have an erosive effect, and you want to have some protection against that, increasing dividend income over time. It's a great way to achieve that.
Very sound advice, Greg. I love Bankrate.com. I was really excited to have you on today. And I really am interested to see what your answer to this next question is going to be. But at what point do you think that our total debt service, federalized and consumer and corporate world of debt, that we'll be forced into a much lower interest rate model? In other words, Greg, will we ever have to adopt a Japanese model similar to a 0% interest rate policy like they've had for literally dozens of years now upon dozens of years?
Well, I think it's a real risk because look at the Fed funds rate, which the Fed raised 9 times in a 3-year period, and we only got a little bit over 2%, and now we're already talking about cutting that back. So the Fed's got very limited ammunition in terms of interest rates, and so that means the next time we do have a recession, it's going to be more than just interest rates that the Fed is going to have to resort to. They're also going to have to go back to the quantitative easing. And, in a more severe economic downturn, I don't think you can rule out the things that we've seen overseas, things like negative interest rates, and even some of the quantitative easing that goes beyond government-backed securities, and actually in the case of like Japan goes into equities. The demographics are against us longer term. So I think, we are going to be a slower growth economy. And so that the downside of growth, I think, is, such that interest rates may go into territory we haven't had to resort to before simply because of where our starting point is now.
You and I think alike. I couldn't agree with you more. And actually, you've already answered the next question for me, which basically was, with all of the artificial stimulus via quantitative easing that we've done, flooding corporate America with corporate debt, flooding consumer America with debt, we're all at these debt maximums again. What type of stimulus other than quantitative easing or rates going to negative is the Fed going to be able to utilize at some point in the future during the next downturn? How do we get ourselves out of this mess? Because we know economics are cyclical, and we know at some point we're going to cycle back down. And demographically, of course, deflation is worse than inflation. So I don't know what other options are there for the Fed to use stimulus, because it seems like they pulled everything out of the hat right now.
Yeah, I mean, I think what they've got to work with is pretty limited, and we may use it up fairly quickly in a prolonged economic downturn. And so I think it's going to go beyond just monetary policy. I think fiscal policy is most definitely going to have to play a role in the next economic recovery.
I couldn't agree with you more, Greg. I want to thank you for joining us from bankrate.com today, and we really appreciate you being on.
Thanks for having me, Jeff.